Welcome, candidates, to the revision of the financial management paper. We are answering question number 4, May 2021, in our today's session. Question 4A, I read, outline 4 factors that could hinder the success of a rights issue. 4 marks. First of all, candidates, what is a right issue? A right issue is an offering of rights to the existing shareholders of a company that gives them an opportunity to buy additional shares directly from the company at discounted prices rather than buying them in the secondary market. So a rights issue is an offering to the existing shareholders that gives them an opportunity to buy additional shares directly from the company at discounted price rather than buying the same shares in the secondary market. And candidates, the number of additional shares that can be bought depends on the existing shareholdings of the share owners. And there are certain factors that can hinder the success of a rights issue. And that is the question. Outline 4 factors that could hinder the success of a rights issue. Part A. Factors that could hinder the success of a rights issue. The first one is the condition of the investment market. Condition of the investment market. How is it a factor? How is the condition of the investment market a factor that can hinder success of a rights issue? Candidates, it is primarily the attraction of the shares offered as an investment which influences the success of the rights issue. But the condition of the investment market also considerably affects the success, such that favorable conditions of the investment market generally ensures the success of the rights issue, while unfavorable condition or unfavorable investment market conditions also affect the success adversely. That is the first factor. The second factor is the effect of the rights issue on the earnings per share. Effects of rights on the earnings per share. On the earning per share. Now, candidates, the new investment takes some time before it bears fruit. And during that period, before it bears fruit, the existing earnings are distributed over a large number of shares. And that brings down the earnings per share, which in turn brings down the market price per share. And sometimes market price comes so much down that it can sometimes be below the price offered for rights shares. So candidates, in such cases, no one would like to exercise his rights, and the right issue becomes a failure. Therefore, the management would be very cautious and should keep in mind the effect of further issue of shares on the earnings per share. On the earnings per share. Of course, by now, candidates, you appreciate that earnings per share is equal to the earnings attributable to the shareholders of a number of shares. So assuming, I'm giving an example to help you understand this point on effects of rise on the earnings per share. Assuming before the issue, there are, say, let's say the company's earnings amount to, say, 500,000, and the number of shares are, say, 1,000. Therefore, the earning per share will be 500 shillings per share. Now, if a company issues rights and the rights are exercised, the company issues, say, 2,000, assuming the earnings are constant. If a company issues additional shares so that there are, say, 2,000 shares, you see the earnings will go down from 500 shillings per share to 250 shillings per share. Why? Because the money that is received as a result of exercise of rights by the existing shareholders, that money does not bear fruit immediately. We all know that if you invest in a project, there is a time lag before the company starts to get cash flows from the investment. So there is that time that elapses between when the shareholders exercise the rights and when the company actually begins to enjoy cash flows from the investment, from the money that was received from the rights. In other words, I'm saying the new investment takes some time before it bears fruit. And during that period, the existing earnings are distributed over a large number of shares. You can see large number of shares from 1,000 to 200,000. And you can see the effect of the such rights on the earnings per share. It brings down the earnings per share. And if earnings per share of a company goes down, that also brings down the market price per share. And sometimes market prices comes down so that it is even below the price offered for the rights. And you see, in such cases, I said, no one would like to exercise rights, and the rights issue becomes a failure. That's the point I'm making in number 2. The third factor is number 3, size of the issue. Size of the rights issue. Size of the rights issue. Rights issue, the size. Now, candidates, smaller size in relation to existing share capital is more likely to succeed as compared to large size. When size of the issue is large in proportion to the issued share capital, then what happens? What happens? I'm saying when the rights issue is large, when it is large compared to the issued share capital, candidates, there are more chances that the market price may come down to such a level that it is below even the price offered for the rights shares. And therefore, it is advisable that the company should offer rights in small size. Okay? In small what? In small size. so that to guarantee the success of the rights issue. The third or fourth factor is pricing of the rights issue. Pricing also affects pricing of the rights issue. Pricing of the rights issue. Now, candidates, the price at which the right issue or the right shares are offered also influences the success or failure of the rights issue to a large extent. And the management has to be very careful while deciding the price to offer to the shareholders for purchasing further shares in the company. The issue price candidates should be determined keeping in mind the condition of the investment market, the market trend, and market trend I mean the market trend of share prices in general and of the company's shares in particular. It is also when pricing also consideration should also be in relation to the size of the issue. When pricing, is important to pay attention to the size of the issue as well as the earning capacity of the company, including the past dividend record and also the effect of the issue on the earnings per share. So these are factors that could hinder the success of a rights issue. Number one, condition of the investment market. Number two, the effects of rights on the EPS. Number three, the size of the issue. Number four, the pricing of the rights issue. 4 marks. I'm going to answer the second part. Part B, I read, Alpha Limited intends to introduce a new product branded Q into the market. This will require an initial investment in machinery costing 4.8 million shillings. The machinery will be installed at a cost of 200,000 shillings and is estimated to have a useful life of 4 years and a salvage value of 800,000 shillings. Additional information. Number one, capital allowance will be provided on the machinery on a reducing balance basis. Number two, annual profits from the sale of product Q will amount to 1,920,000 shillings before deducting depreciation on the machinery. Number three, an investment in working capital amounting to 340,000 shillings will be required on commencement of the project. Number four, the firm pays corporation tax at the rate of 30%. Number five, the cost of capital is 15% per annum. Required, Roman 1, the annual depreciation rate, 3 marks. Roman 2, the total initial cash outlay, 2 marks. Number 3, the total terminal cash flows, 2 marks. Number 4, the annual net operating cash flows, 5 marks. And lastly, using the net present value approach, advise the management of this company on the suitability or otherwise of the project. How many marks? 4 marks. Let's take the first part. Roman 1, annual depreciation rate. Annual depreciation rate. Annual depreciation rate. First step, put down formula. Formula. Candidates is dependent on the information provided within the question. In this question, the issue to do with the depreciation, we have information on depreciation we can read. We are given the cost of the machinery. We have the salvage value of 800,000. What else do we have? We have the useful life of 4 years. Therefore, candidates, the rate of depreciation R will be determined as follows. R, we have the formula here. R is equal to 1 minus S over C raised to 1 over N. Now, if you went to, if you've done secondary mathematics, candidates, we know this formula can be rewritten as follows. It can be simplified as follows. 1 minus this nth root. We get the nth root. The nth root of S over C, where C is the salvage value. I mean, S is the salvage value. C is the cost of the machinery. N is the economic life. All these variables we have in this question. Okay, we have we are told that this will require an initial investment in machinery costing 4.8. There is also the installation cost. Installation cost, candidates, is a capital expenditure. Therefore, the initial investment will be equal to the cost of the machine plus the installation cost. That will be 4.8 million plus 200,000, which is equal to 5 million. So that is the cost of this machine, cost of the machine. So this will be equal to 1 minus N is the economic life, and the economic life is 4 years. Yes, 4 years. Yes, 4 years. 4 years. S is the salvage value. The salvage value is 800,000 shillings. 800,000 shillings. Divide by the cost. The cost is 5 million. 5 million. So the rest is the work of the machine, the calculation we are allowed. So I'm going to work out that, candidates. I'll begin with 1. I'll punch here 1 minus, I open a bracket, then I have 4th root. Just press 4. Then I go to shift. Then I press the nth root. Then I open another bracket, punch 800,000, divide 5 million, close the bracket, then close it again. I'll get 0.367, 0.367. When converted into percentage, this is 36.7. I can decide to round it off to, this is 37%. So the annual depreciation rate, 37%. We've answered part B, Roman 1, 3 marks. Then Roman 2, what is the question? The question is total initial cash outlay. Initial cash outlay total will comprise 1, the initial investment. We'll have the initial investment, which is 4.8 million. 4.8 million. Then you are going to add the installation costs. Installation cost of 200,000 shillings. 200,000 shillings. Next in line, we read, candidates, that in additional information number 3, An investment in working capital amounting to 340,000 shillings will be required on commencement. On commencement. Before these projects begin, the company has to raise 340,000 shillings as working capital. Working capital of 340,000 shillings. So that will be the total cash outlay. That is the amount that will be required at the start. 200 plus 340. 5,340,000. That is the total initial cash outlay. This is the amount that will be required at the beginning of this project. 5,340,000. You've answered number 2. Then number 3, the total terminal cash flows. Terminal cash flows. Number 3, terminal cash flows. The first one, obviously, is the salvage value. Obvious terminal cash flow is the salvage value of 800,000. We add the working capital that will be recouped. Working capital that will be recouped. We read that an investment in working capital will be required on commencement of the project. So there is 340 working capital recovered of 340,000, giving a total of 1,140,000. That is the terminal cash flows. Terminal cash flows. That's number 3. Then the next part is the annual net operating cash flows. Annual net operating cash flows. Annual net operating cash flows. Annual, we are going to calculate the annual operating cash flows, that is each year. So we'll have year 1, year 2, year 3, year 4, because we read that in additional information number 2, that annual profits from the sale of Q will amount to 1,920,000 before deducting depreciation on machinery. Earnings before depreciation. So we are going to have earnings before depreciation and tax. Year 1, year 2, year 3, year 4. These are in thousands. You'll have earnings before depreciation and tax, 1920, 1920, 1920, 1920. Earnings before depreciation and tax. We'll then remove depreciation, which we need to calculate. So I'm going to have working 1 for depreciation at this end. Depreciation. How do we calculate depreciation? We read in additional information number 1 that capital allowance will be provided on the machinery on a reducing balance basis. Reducing balance basis means that we are going to apply the depreciation rate of 37% on the reduced balance of the machinery. So depreciation, the cost, first of all, the cost is how much? We calculated the initial cost. The initial cost is going to be 5 million. 5 million is the initial cost. Then depreciation, year one, will be 37% times 5 million. 37% times 5 million. 37% times 5 million. 1,850,000. We get the reduced balance minus 5 million. 3,150,000. This is what we are referring to as the reduced balance. At the end of year one, the machinery has lost value of 1,850,000. So this is the reduced balance. So the depreciation year two, depreciation, this is year one, year two will be 37% times 3150. 3150.37 times 3150. 1165,500 minus 3150. 198, 1984, 500. This is the reduced balance at the end of year two. Therefore, depreciation year three is equal to 37% times 1984, 500. 1984, 500. 0.37 times 1984, 500. So I'm getting here 734,265 minus 1984, 500. Reduced balance 1250 to 35. 1250 to 35. Then lastly, depreciation year 4, 37% times the reduced balance times 1250 to 35. 1250 to 35 times 0.37, that is equal to 462, 587. 1250 to 35 minus 462, 587. The reduced balance at the end of year 4, 787, 64, 8. So we have calculated the depreciation per year. Depreciation per year. Depreciation year 1, we have it there. Depreciation year 2, we have it there. The depreciation year 3, we have it. So we're going to deduct depreciation from the earnings before depreciation and tax. Year 1, 1850. Year 2, 1165.5. 1165.5. Year 3, 734.265. 734.265. Then lastly, 462.587. So I have 1920 minus 1850. 70. Next, 1920 minus 1165.5. 4.5. Next we have 1920 minus 734.265. 1185.735. Then lastly, I have 1920 minus 462.587. 1457.413. So these are earnings after depreciation, earnings after depreciation, earnings after depreciation, but before tax. Earnings before tax. Let me just say earnings before tax. Earnings before tax. So we are going to apply a tax rate of 30%. 30%. 70 times 30% is 21. Next, 30% times 754.5. Taxation here, year 2, 226.35 minus 754.5 minus, I have 52.8.15. This one is just 70 minus 21, it's 49. Next, apply 30% on that. 30% times 1185.735 is 355.721. That is 1185.735 minus 355.721. Earnings after tax, 30.014. Then lastly, 30%. 30% times 1457.413. 437.224. 1457.413 minus 437.224 is 1020.189. So these are earnings after tax. So we are going to add back depreciation. Why are we adding back depreciation? Because depreciation is just a provision. There is no money that was paid out. It is a provision that was made. That's why we need to add back depreciation. 1165.5, 734.265, 462.587. Add back depreciation. Add back depreciation plus 462.587, 1482.776. We add back 830.14, 0.01014 plus 734.265, 1564.279. We are adding back depreciation, 528.15 plus 1165.5, 1693.65, add back 49 plus 1850, this is 1899. These are the annual net operating cash flows. Annual net operating cash flows. Annual net operating cash flows. So we've answered part 4. Then part 5, using the net present value approach, advise the management of this company on the suitability or otherwise of the project. So we're going to calculate the NPV. This is 5. We know NPV is equal to the present value of cash inflows minus present value of cash outflows. So you'll have year 1, years, year 1, 2, 3, 4. We have the cash inflows, cash flows. These are the cash flows. This is cash that will be received at the end of year 1, at the end of year 2, at the end of year 3, at the end of year 4. These cash flows are in future terms, so we need to discount them. But let me put down the cash flows. Then put down the cash flows. This is 1899. Then this is 1693.65. 1564.279, 1482.776. We are going to have the present value interest factor at the rate of 15%, 15% N. We are going to read these factors from the tables. We read from the tables. I have my table here. Discounting 15%, 15% year 1, I'm reading 8696, 8696. Year 2, 7432, 7432. Year 3, the discounting rate 64. This is 75, 8696. This one is 75, 7561. Next I have 6575, 6575, 6575, 5718, 5718, 0 point, 0 point, 0 point, 0 point. So these are the factors, discounting factors. I'll multiply the cash flows with the present value interest factors to get the present values. The present values. Beginning with the first year, we have 1899 times 0.8696. This will be 1651.370. Then we have 1693.65 times 0.7 561. This is equal to 1280.569. Next I have 150. Is it 150? This is 156. 156 4.279 times 0.6575. I'm getting here 1028.513. Then I have 1482.776 times 0.5718 is 847.851. These are cash flows. Then there are the terminal cash flows that will be received at the end of year 4. Terminal cash flows. These are terminal cash flows amounting to 1,140,000, comprising of the salvage value and working capital that will be recouped. This is a cash inflow. At the end of the 4th year, there is a salvage value. The machine can be sold and raise 800,000 shillings. Then the working capital that was injected at the start of the project, this working capital will be recouped. That is a cash flow that will be recouped, that will be recovered at the end of the 4th year. Therefore, the future value there is 1140. We are going to discount using the present value interest factor 15% for years 57, 18. We use the same discounting factor there. That will be 1140 times 0.5718. This is equal to 651.852. These are the present values. I'll get the total, then deduct the outflows. The total there will be plus 847.851 plus 102.8.513 plus 1280.569 plus 1651.370. The total is 5460.155. That is the total present value. We deduct the cash, the present value of cash inflow. The present value of cash inflow is 5 million. 5 million. That is in present value already, because that money will be invested now. That money is 5 million. So 5 million 460.155, and this is positive NPV. This NPV is positive. So what is the advice? You are to advise this company. The company needs advice using the net present value approach, which you have calculated the net present value. Advise the management of this company on the suitability or otherwise of the project. The advice is based on the calculation here. Advice. The company should undertake the project. Why? Because it yields a positive net present value of shillings 460,105. The company should undertake this project, because we read that Alpha Limited intends to introduce a new project. This project has not begun. So before undertaking such a long-term project, it is important that a company evaluates the viability of a project. And one way in which projects can be evaluated is by using the net present value technique. And the decision criteria for the net present value technique is that if NPV is positive or more than 1, then the company should undertake the project because it will yield a positive NPV. But if the NPV is negative, then the company should reject the project based on the negative NPV. If the NPV is 0, the company is indifferent. The company can either undertake the project or reject the project. We've answered question 4. Part A carried 4 marks, Part B, Roman 1, 3 marks, Part B, Roman 1, 3 marks, 1, 2, 3 marks. Part B, Roman 2, how many marks? 2 marks. Calculation of total cash outlay. Total cash outlay, 2 marks. Total cash outlay candidates comprised the initial investment, the installation costs, and working capital that is required at the start. The question is total initial cash outlay. That is the cash that will be needed before the project commences. Then Roman 3 is a total terminal cash flow. This is money that will be raised out of the project, the cash flows that can be generated at the end of the economic life of the project. And that comprised the salvage value of 800,000 and the working capital that will be covered of 340,000 shillings. These are again just 2 marks. 2 marks. Then part 4, annual net operating cash flows. Annual net operating cash flows, 5 marks. And the annual operating cash flows, we were to first of all put down the earnings before depreciation and tax as provided in the question. Then we deducted the annual depreciation, which was not given in the question. We had to calculate depreciation. This is the working for depreciation. This is depreciation year 1, depreciation year 2, depreciation year 3 and 4. And this depreciation is to be calculated using the reducing balance method. And the reducing balance method candidates, the depreciation rate that we computed in B1 of 37% is applied on the reduced balance. Reduced balance is equal to the cost of the machine minus the accumulated depreciation for each year. So that is what we did in calculation of the depreciation. Then there is a tax that is given in the question, tax of 30%. Tax of 30%. Tax is applied on earnings before tax. Then after removing the earnings, the tax, we have what we call earnings after tax. These are the earnings after tax. Then we had to add back depreciation. Add back depreciation. Why do we add back depreciation? We add back depreciation because depreciation is just a provision. There is no money that was paid out. It's only an allowance that is applied on the cost or the reduced balance of the asset. So therefore depreciation has to be added back because it is a non-cash item. And here we are dealing with cash flows. if you are to deduct, we only deduct money that was paid out, like the tax is paid out, is expected to be paid out to the government. So after adding back the depreciation, then we have the annual net operating cash flows. Annual net operating cash flows, and that would earn the 5 marks. Then in number 5, we were to use the assets, so therefore depreciation has to be added back because it is a non-cash item. And here we are dealing with cash flows. If you are to deduct, we only deduct money that was paid out, like the tax is paid out, is expected to be paid out to the government. So after adding back the depreciation, then we have the annual net operating cash flows. Annual net operating cash flows, and that would earn the 5 marks. Then in number 5, we were to use the annual net operating cash flows to calculate the NPV. NPV we've seen is equal to the present value of cash inflows minus present value of cash outflows. These are cash inflows. Okay, the annual net operating cash flow, these are cash inflows. Then we add the terminal cash flows as calculated in Roman 3. So this allows us to determine the NPV. Then it is on the basis of the NPV that we advise this company to invest in this project because it yields a positive NPV of 460,000 shillings, 105. Thank you for attending our today's revision session. These kind of questions, we've answered many of them on this forum. I advise you to continue revising, especially if you are preparing for exams. Do more questions, then you will be in a position to answer any question in capital budgeting. Thank you. God bless you. Bye-bye.